What if I told you the strongest jobs report in 9 months could actually delay your portfolio gains? Today we're breaking down how US employment is reshaping the Fed's rate cut strategy and what it means for stocks and Bitcoin heading into 2026 and beyond. The December jobs report just dropped, and it's a blockbuster. The US economy added 256,000 jobs, crushing expectations and pushing unemployment down to 4.1%. This marks the largest job gain since March 2024. Healthcare, government, and retail led the charge, adding a combined 120,000 positions. Wages grew 3.9% year over year, keeping consumer spending alive. But here's the twist. A strong labor market is a double-edged sword. The Federal Reserve has already cut rates by 175 basis points since September 2024, bringing the federal funds rate down to 3.5 to 3.75%. But with inflation still hovering around 2.8%, above the Fed's 2% target, and jobs staying resilient, Powell has a problem. The latest dot plot signals only one additional rate cut in 2026. Goldman Sachs expects a pause in January, with cuts resuming in March and June, targeting a terminal rate of 3 to 3.25%. Translation: the era of aggressive rate cuts is over. The Fed is now in wait-and-see mode. For equities, this mixed picture creates volatility. Morgan Stanley projects the S&P 500 could reach 7,800 in the next 12 months, a 14% gain, driven by corporate tax cuts and AI-powered productivity. But here's the caution. High valuations on mega-cap tech stocks and slower rate cuts could limit upside. Some analysts even call 2026 a potentially lackluster year for the S&P 500. Now Bitcoin. Lower interest rates historically boost risk assets like BTC by increasing liquidity and weakening the dollar. Many analysts see Bitcoin reaching $120,000 to $130,000 by late 2025. Some even call for $200,000. Looking into 2026, the structure remains bullish, with projections ranging from 88,000 to 130,000 depending on macro conditions. But remember, Bitcoin's volatility means sharp corrections are always possible. So what's the takeaway? The US labor market is too strong for aggressive rate cuts, but not strong enough to spark recession fears. Expect a slow grind lower on rates through 2026, favoring quality growth stocks and Bitcoin as a hedge against dollar weakness. One wildcard: Fed Chair. Powell's term expires in May 2026. A new chair could shift policy direction dramatically. Stay informed, stay ahead. I'll see you in the next one. Thank you.